Prospects for the Bank of Canada holding steady on rates next week rose after September's Consumer Price Index report released earlier today showed that inflation came in lower than expected. The Consumer Price Index was up 3.8% year over year in September. That compared to the 4% rise in August. That is still nearly double the Bank of Canada's 2% target, though. For more details on today's data and what it could mean for the central bank, joining us now is Charles St. Arnaud, chief economist at Alberta Central and a former economist at the Bank of Canada. Thank you so much for joining us.
Good afternoon.
So what do you make of this somewhat unexpected progress being made on the headline, but also on core inflation as well?
Well, I think when we look at it in terms of comparing to the surprise we had in August, it feels like August was kind of just an upside surprise that will be much more temporary. And it seems like we could be back on track in terms of continued moderation in inflation. But as you pointed, inflation is still high. Momentum is still too high for the Bank of Canada, but I'm sure the officials of the bank are feeling a bit more at ease with the number this morning. Yeah,
it is interesting because we did have that headline rate falling even below 3%, so nearing the Bank of Canada's 2% target, but then reaccelerating, like you mentioned, in the summer there in August. So do you think that there's a possibility that the trend is going to, continue downwards from here? We might not see another sort of August?
Well, there's still a probability, but when we look in terms of what has been kind of causing price pressure or what are the risk in terms of price pressure, gasoline prices have not increased as much as what we've seen in the summer with oil prices. Our prices have stabilized and actually came back and declined a bit over the recent weeks. So it kind of signals that at least on the energy front, there's a bit less risk to inflation increasing. However, when we look at the latest employment report, wages are still increasing at a fast rate and actually accelerating. So that increased the risk that inflation will be much stickier than what the Bank of Canada expected.
What about on the consumer demand side of things, Charles? I recall the central bank governor talking about how he sees progress being made, that spending or that the demand portion is easing because of these higher interest rates. Do you see that, progress being made?
Well, we're seeing it in various data. So if we look at just the housing market, we're continuing to see some underperformance in terms of transaction. When we look at the data from last week for the whole Canadian market, we're seeing at the national level a decline in transaction. When we look at retail sales, they've been relatively sluggish, and even more when we look at retail sales per capita, they're actually declining. So showing that households are actually reducing their spending. So that's why the economy is really reacting to the higher interest rates.
We've heard a lot about food prices in particular, food price inflation in particular the last couple of months. Much longer than that, but over the last couple of months because the federal government has been getting involved and trying to get grocers to help stabilize food prices. Those are some efforts that were recently made just ahead of the Thanksgiving long weekend. We are seeing the increase in food prices decelerate a bit. So do you think that we're going to see more progress on the food front, not even considering what Ottawa and the grocers are trying to cook up?
Yeah, well, I think we were starting to see that moderation in prices, especially on the food side in recent months. Part of it is the global environment for food prices had been stabilizing, but it takes time before global commodity prices starts to feed into inflation. It takes about more than 6 months. So we were starting to see that happening. There's also a big part that was part of the cost of food, especially in Canada, is transportation. With energy prices, gasoline prices kind of stabilizing and not continuing to increase, that is also providing some respite in terms of inflation. So all that kind of points to continued moderation in food price inflation. But the question is to what extent we'll come back to something that's more normal and below 3%.
Yeah, and we heard within the Bank of Canada Business Outlook survey yesterday that businesses are still expecting to be passing on larger than pre-pandemic price increases.
Yeah, and I think for me, that's where the wage increase that we got last week are probably a bit more concerning for the Bank of Canada, because higher wages are a higher input cost for businesses. And if those businesses are more willing and faster to pass this extra cost, that's why you could have that feedback loop of higher wage leading to higher inflation, higher wages, and kind of having that more persistent inflation. And I think that's part of the risk the Bank of Canada is seeing out there.
So how do you think the Bank of Canada is looking at this latest data when it comes to its next decisions?
Well, I think if we look at all the data we've gotten there actually so far this week, and the result from the CPI release kind of shows that, okay, the upside surprise we had in August was really kind of a temporary uptick in inflation. It doesn't seem it will be long lasting. Dynamic is still suggesting that core inflation is growing at about 3.5% or so. The three-month annualized rate, so still too high for the Bank of Canada to be comfortable. And also, when we look at the Business Outlook survey and the survey on consumers yesterday, a vast majority of respondents are still saying that we haven't seen the full impact of the interest rate. So it suggests that maybe the Bank of Canada should be patient, that all the tightening that has been done over the past year has not yet filtered through completely to the economy.
Yeah, I thought that was really interesting as well, that there were so many consumers in particular who were thinking, yeah, this isn't it yet. We haven't felt the worst of it yet. And maybe it's some of, the Canadians who haven't had to get a new mortgage yet, but know that that's something that's, on their to-do list in the new year.
Yeah, I think there's a vast majority of consumers or households that have a mortgage that's coming to renewal within the next 1 to 3 years, and they're looking at it like, well, if rate stays here, like the Bank of Canada has been telling them, rates will be higher for longer, so be prepared that you will renew your mortgage at a higher rate. So those households know that, well, the recent increase have not yet filtered through into their budget.